All right, home straight, halfway up the home straight, actually. Good morning. I'm Martin Kelly. For those that I don't know, I'm the company's CFO, joined today by Susan Kendall, who runs strategic finance. So I think it's quite clear for those who follow us closely and for those who are newer to our story, you've heard a very consistent story today. We've been very clear about our targets. We're quite transparent. We track closely against that. And we want to make sure that progress in our business is clear and transparent to all of you. We are seeing increased momentum in our business, and I think that's clear from what you've heard today. Why is that? It's the opportunity set for us is just much clearer, and it's converting to financial results. And you can see that from all the presentations that you've listened to this morning. The foundations of each of our businesses are strong, and they're producing consistent results. And the more recent priorities that we've been talking about now for several years, think global wealth, think capital solutions, think bank partnerships, including with respect to annuity distribution, are all creating the uplift in earnings that we're now seeing come through earnings. And then we expect the newer priorities, many of which we've touched on or scratched the surface on today, to create the earnings growth in the years that are ahead of us. In terms of capital, we expect to create more than $20 billion of capital to invest or return to shareholders over the next 5-year period. And that's the result of very strong earnings in each of our 3 main business lines. And when you combine the capital creation with the strong earnings growth, we expect a 20% return to shareholders at current multiples and current prices. So for those who are newer to our story, some know this very well, but one quick slide just to lay out the earnings construction, which we'll then step through. We have 3 earning streams. 2 are growth businesses, fee-related earnings growing at 20% from our asset management business, spread-related earnings to grow at 10% from our retirement services business, and then principal investing income, which is net carry. And we think about that more as a cycle average business, very important to creating capital, very important to paying people, and highly value creative over time. And we'll weave in some of the points that David and Matt made earlier. We laid this out at our prior Investor Day 3 years ago. We've not made changes. I wouldn't anticipate that we do. This represents how we operate the firm. So let me pivot back to a slide that Mark used very early, and there's no need for me to recap the update through 2026. I think you've heard that loud today, and you can connect that to what you've already heard. The one metric that we haven't touched on that's relevant is adjusted net income. That's our primary non-GAAP metric. We had put a target out of $9 per share for 2026 3 years ago. We expect to exceed that. We'll report more than $7 this year. And so we're certainly on pace to exceed that metric. So looking ahead on the right-hand side of the page, again, the top 5 components here on the page, the top 5 metrics are all what I think of as consequences of our plan, each of the earnings metrics. The next 4 in the lighter blue are the drivers of the plan. And you've heard from everyone this morning around the strategy behind each of these drivers. Mark made the point early on that origination is really important, probably the most important metric. And I'd make 3 observations on these metrics. Firstly, if you look at the trend line between where we expected to be in 26 and where we now expect to be either over the 5-year period to 29 or in 29, that demonstrates the momentum that's building up inside our business. And I think that does it quite clearly. Secondly, these are all connected. Origination fuels growth in Athene. Origination fuels growth in our capital solutions business, in our global wealth business. It brings in third-party capital that's attractive institutionally. And it works in reverse as well. ACS opportunities can create origination. And so we don't think in silos. I think this is really important to the culture point that we've been emphasizing. This wouldn't work if we had distinct strategies and distinct teams. This only works because we are a flat model and we're open architecture, which we've been talking about today. So the other point clearly is there's an earnings multiplier on these activities. if we originate a dollar of asset, it has multiple homes around the system. It can create spread earnings for Athene. It can create multiple forms of fee earnings for the asset manager, including management fees or capital solutions fees or spread promote on our global wealth businesses. And so it's a really powerful accelerant of earnings growth throughout the firm. A couple of other points on this page. This assumes no inorganic growth. So this is an organic plan. This does assume that we get the share count to 600 million shares by 2029 in terms of the EPS metric that's noted, and I'll dig into that more a bit later. So moving on to our growth trajectory. You've heard today 20% growth in FRE, 1.9 billion becomes 5 billion over time. In our spread earnings business, in Athene, 10% growth, so 3.1 billion becomes the same $5 billion over time. So two $5 billion businesses. When you combine that with principal investing income, tax affected, and deduct financing costs and so on, you get to our primary earnings metric, which is $15 per share by 2029. And I think you should assume, I'm not going to touch on it, so just assume no other changes to the construction of that. Assume no changes in the tax rate or the cost structure relative to the pace that we're on today. So with that, I'll pass over to Susan to touch on the asset manager. Susan.
Taking a look at the asset manager in more detail, with FRE growing at twice the pace of SRE, we do expect our income to shift from a majority in spread-related earnings today to over 50% coming from asset management in FRE and PII. And within FRE, growth is expected to be driven by third-party management fees, from less than 60% 3 years ago to a target of more than 70% in 5 years, as we serve a growing set of clients across the risk-reward spectrum. As shown today, we are growing from a strong foundation, with a large and growing franchise in Athene, leading origination capabilities, a strong capital solutions business, and an established track record in flagship PE and other core institutional products. In total, these scaled businesses represent about 3/4 of our revenue today and are expected to grow by 1.5 to 2 times over the next 5 years. They also provide the core capabilities and reinvestment capacity to lean into growth drivers for the next 5 years, continuing to grow third-party credit, diversifying our equity franchise, as you heard earlier, into climate, infrastructure, AAA, and hybrid solutions, scaling our global wealth business as we serve the large and underpenetrated market for individual investors, and further penetrating fixed income as we redefine the market for public versus private credit. These businesses are only about 1/4 of our revenue today, but growing quickly, and should well more than double over the next 5 years. And finally, we expect equity replacement in new retirement markets to begin to contribute to revenue over the next 5 years, although they're in much earlier stages today. As we invest in the business, we expect revenue growth to move into the high teens range on average, including outsized growth in those years where we have a flagship PE capital raise. As we execute on this growth plan, we are focused on a few key metrics, as you've heard earlier. Increasing our total originations to 275 billion or more, stemming from our proprietary origination platforms, credit and high-grade capital equity originations. Scaling our annual inflows from 125 billion today to over 150 billion on average, with growth across global wealth, institutional capital, and Athene inflows, and growing ACS fees to roughly $1 billion, driven by diverse activity and increasing flows across our franchise. But the primary metric we'll use to measure success is our ability to accelerate FRE growth to roughly 20% on average for a $5 billion FRE business in 5 years. Similar to revenues, our fee-related earnings will vary year by year, with stronger growth in years where we have a flagship capital raise. But on average, we expect earnings growth to accelerate as our initiatives mature. We also expect a significant contribution from principal investing income over the next 5 years as the realization environment improves and we continue to grow our carry-eligible assets. As a reminder, principal investing is comprised of realized performance fees, or gross carry, and realized investment income, which we expect to be modest, offset by performance-related comp, financing costs, and other corporate expenses. Realized performance fees are an important driver of employee compensation, and principal investing income is a significant source of capital generation for the firm. In aggregate, we expect to earn roughly $4.5 billion of PII in total over the next 5 years, with variability year by year depending on the environment. This PII outlook is supported by strong fund performance, which not only generates carry on existing funds, but also helps to attract new capital. We expect to generate $10 billion or more of gross realized performance fees over the next 5 years, with the majority coming from our established flagship PE funds. Fund 9 is our 2018 vintage flagship fund and is fully invested. As you heard from Matt earlier, Fund 9 continues to outperform the industry, with gross and net IRRs of 29% and 20% respectively, and among the strongest DPI metric versus our peers. Fund 10 is our recent 2023 vintage fund. Fund 10 is already roughly 50% committed, with performance off to a strong start as well. At this investment pace, as you heard earlier, we would expect to be in the market with Fund 11 by late next year. And with that, I'll turn it back to Martin to cover SRE.
Great, thank you. So let me pick up on SRE and touch on 4 areas of focus. And you saw some of the metrics on earlier slides from Jim and Grant. The Athene ecosystem today is about a $300 billion balance sheet. The retained business is about a $240 billion balance sheet. The retained business creates spread-related earnings. We've raised, as you saw, close to $10 billion of capital via the ADIP franchise, which today supports about $60 billion, the differential in assets, and will ultimately be about $100 billion when fully invested. We expect ADIP to continue to be strategic to Athene and capital efficient for the group. It has clear capital benefits, efficiency benefits to Athene, which I'll talk about in a moment. It also allows us to create equivalent FRE of the assets that are managed within ADIP. But that's a choice we can make, and we'll make that choice as the business continues to grow and scale. Secondly, we've seen 2 pretty significant interest rate transitions. We lived one on the up post-COVID, where we're living one now on the down post-inflation coming back down, with the equivalent of 2 cuts behind us and more ahead. And the earnings profile of the business does look different when we go through periods of rate transition. The alternatives portfolio has performed well over time. Grant talked about this. We're very happy with the performance. It's had 1 negative quarter in 40. That said, we've seen some recent underperformance, and so we're taking actions to align it more closely with the AAA portfolio, which I'll talk about. And then lastly, in view of all of this, particularly the interest rate transition and the actions that we took over the last year to manage our interest rate position, we're providing our current outlook for SRE in 2025. So I think it's useful to look at the forward growth expectations, and you've heard this from Jim and Grant, 15% and 10% assets and earnings respectively, in the context of the last decade. And if you look at what we call the pre-ADIP period, that was after the benefit, the full run rate benefit of the big Aviva portfolio acquisition, but before any capital was raised in ADIP. And over that time period, the growth rate on assets and earnings was pretty similar, mid-teens at 16 and 14 respectively. During that time, we owned 100% of the business, and we operated with significant excess capital to fund inorganic growth, which was relevant then, which we didn't know when and how and in what size it would materialize. We also maintained excess capital to qualify for ratings upgrades, which we've since achieved. So as a result of that, our growth was more limited. Over the last 5 years, since we raised ADIP 1, we've seen 20% plus growth in each. ADIP has allowed us to be more capital efficient. Top line growth over this period increased from $28 billion in 2020 to expected to be $70 billion this year. And we gave up part of the SRE earnings as a result of the ADIP co-share. So looking ahead, we have both ADIP capital at our disposal, and we have likely excess capital within the Athene system. And so we have more flexibility today looking forward. And you've heard this from Jim and Grant, we expect around 15% asset growth from here. Today's $70 billion of top line growth will average around $85 billion over the next 5 years. And then we'll have 10% SRE dollar growth with ADIP contributing to the difference between the two. But the future use of ADIP, including raising ADIP 3, is a choice. And it's a choice we're fortunate to be able to make, given the strong track record that we've had in each of ADIP 1 and 2. So, SRE. What drives SRE? It's two things. It's asset growth and it's net spread. Asset growth is quite straightforward. You heard on the inflows and the expectations around inflows and diversification from Grant. Runoff, as we've lived through, is highly predictable both on the up and on the down. And then ADIP partly funds net asset growth, which is a choice we can make periodically. Of the four components of spread on the right, it's really the first one, which is credit spread on growth, which is the most important driver of SRE growth over time. The other three items can introduce transitory impacts up and down, but they tend to mean revert over time. So looking at that a little bit more closely, spreads will be wider at certain times. It's the credit market. They'll be narrower at certain times. At times, they're both in different asset classes, which is what we're seeing right now. Spreads are tight today in CLOs and resis. Spreads are wide to the average on commercial real estate debt. But over time, and like the other three components, spreads tend to mean revert over long periods of time. Liability costs are quite stable outside shorter-term competitive transitory impacts. And on rates, I'd make 2 points. Rates, the absolute level of rates has little impact on the business over time because both assets and liabilities reprice to wherever the term rates are at that point. And then the deviation in rates over time is also quite predictable, but for transitory periods, which we've lived through and we're about to live through again. And then lastly, alternatives. I'll come back. There's a slide to follow on alternatives, which lays out our actions we're taking to modify that portfolio. So, if we move ahead to the next slide here, it's interesting that over time you can see the stability of net spreads in the business. This is a decade, on the right-hand side here, this is a decade in the making. And you can see, again, points in time where spreads are narrower or wider, but spreads mean revert over time, and it's 131 basis points over this period of time. Also interesting that the business we're writing today, which is the left-hand side of this chart, first half of the year, we wrote business at 140 basis points. So that's approximately what we need to do. That's what we plan for as part of running the business and as developing our longer-term plan. I think it's also interesting to look at spreads right now and where we're writing business right now in the context of what's changed inside the last 12 months. So today the market sees, as we all know, 4 to 5 more rate cuts than expected last November. CLO spreads have tightened meaningfully, and as a consequence of that, refi and prepayment rates have increased. We're still writing business at 140 basis points. It's less than periods of time within 2023, but it's still consistent with our long-term expectations. And that really connects back to the whole origination thesis and the plan around ability to source interesting, appropriate investment-grade fixed income assets that are appropriate for Athene's balance sheet. You saw this chart earlier from Mark, and just to put this in more context in terms of the transition, we did experience significant increases in interest rates in the period of time post-COVID. We lived through that. We had a significant spike in earnings 22 and 23, and we out-earned in that period of time. We also carried more floating rate assets, as Mark mentioned. And then when rates were high, we entered into hedges to bring down that floating rate exposure. And so today, pro forma for that, in actual terms, we're 7% floating, or $15 billion of net exposure. We also, when rates were high, bought what we call countercyclical assets. Think defensive assets like treasuries that we can sell when rates decline and reinvest at wider spreads when the opportunity is available to us. And so both those actions are part of the earnings transition story as we look from 23 to 24 to 25. On alternatives, we're very happy with the performance of the portfolio. It's been a long-term, well-performing portfolio. What we have experienced up until now is that the alternatives portfolio is represented approximately 70% by AAA and 30% by other. And the other included some strategic retirement services platforms, of which we are in the process of selling or repositioning to pro forma to a position where we own just Athora and Venerable. And so once some of that is done, some of that is in the period just ahead of us. Once we are done with that, the alternatives portfolio will be about 80% AAA, and you can see the impacts on returns over both the last 12 months and the trailing 3 years. Had we done that, and the portfolio construction was what it is pro forma for those actions, about 200 basis points higher, and very close to the long-term 11% expectation. One more important note, because of the focus on this and the importance of understanding performance of the alts, we do plan to publish each quarter going forward around quarter end the expected returns of AAA in that quarter, and that'll just allow a shorter term modeling in view of that particular quarter. So how does this all connect? Similar slide to what you saw earlier from Mark. In 2023, we out-earned for the reason that rates increased significantly, and we rode the ups on the floating rate portfolio. The out-earning was about $300 million. So we believe an appropriate level of base earnings for 23 is around $2.8 billion. In 2024, we created close to 10% earnings growth from new business. We further created earnings from optimizing the existing asset portfolio, and we actually benefited, as Mark said, by about $100 million due to the run rating benefit of higher rates, notwithstanding the fact that short rates are now just starting to come down. We expect to end 2024 right on top of what we previously said, with the reported SRE around $3.2 billion, which would be 14% growth off the rebased 23, with a further $300 million if we assumed alts performance at 11%. And so on a comparable like-for-like basis, that represents approximately 4% earnings growth for the year, in line with our prior comments. For 2025, we expect the base business to grow at the same approximately 10% growth rate. We expect interest rate headwinds of about $300 million, and we expect some benefit from both asset portfolio positioning and alternatives returns. So assuming alts returns at 11% for next year, assuming everything else stays the same, we would report SRE for 2025 of $3.5 billion, or approximately 10% growth off 2024. I think it's just standing back for a minute. I think it's important, and this sort of threads back to some of the earlier comments. We operate the business as a principle. We make decisions that are appropriate for the long-term benefit of the business. We don't reach for risk. We don't play capital arbitrage. We run lower leverage than the industry average. We want long-term profitability, and we're performing well in an environment when many peers are experiencing flat to declining earnings. So with all these comments in context, particularly the interest rate transition from 24 to 25, we expect the longer-term growth of the business from 24 to 29 to approximate 10%, with SRE dollars targeted to be around $5 billion in that last year. And from a capital perspective, this assumes consistent use of ADIP. It assumes we expect that Athene will be capital sufficient or generative through this time frame, and we assume a constant annual dividend to the holdco of $750 million each year. So let me move on. Last topic on holdco capital. We're very pleased with the progress we've made on capital in the last 3 years since our last Investor Day. We targeted an upgrade in our ratings, which we achieved. We've built a strong liquidity position to be offensive. We've migrated all of our debt issuances to be SEC registered out of the holdco. That's attracted a whole new buyer base of debt investors into our capital structure. We issued capital in the form of a mandatory convertible when it was attractive to do so to fund Athene's outsized growth. and we've been active in immunizing shares issued to employees. So, I think also importantly, we will buy back stock opportunistically when we can. In the quarter that just ended yesterday, we bought back 4 million shares in the market since our prior earnings call. So moving ahead to the next 5 years, we're targeting, as you heard this morning, $21 billion of capital to invest in the business and return to shareholders. And that's driven by each of our earnings components with the heavier emphasis on FRE, as you'd expect. This is after tax, after the cost of immunizing regular way employee stock issuance. And then we look at the uses of that. We are indicating 3 lots of $7 billion. The first to pay the base dividend, which incorporates into it a 10% annual growth, up from the current 7.5% annual growth. And that reflects about half the growth rate of what we expect to be the FRE earnings growth. Secondly, an amount of shares to bring us down to 600 million shares, which is the base math we used in the EPS calculations throughout today, plus clearly some excess for further repurchase. And then $7 billion to grow either our asset management business or our retirement services business. Currently unidentified, may happen, may not happen. If it doesn't, we can use it to buy back stock. In either case, accretive to our base earnings growth with approximately similar returns on capital. So in closing, 4 simple messages. We are tracking at or ahead. We're very pleased with our progress. I think we have a high conviction of continuing to meet our targets in view of the momentum in the business that you've heard about today. We are expecting 15% plus earnings growth in ANI per share over this time period. We expect to generate significant amounts of capital. Some is earmarked, some is not. We'd expect around a 20% return on that capital when it's put to work. And then we're very focused on shareholder value. We are all stock owners, as you are. And if you look back, we've returned 7x on the stock price since IPO, Noah's opening chart. And we expect this plan at current multiples, at current prices, to return 20% to shareholders through 15% earnings growth and then other forms of capital return.